everyone. Welcome to the Monday Dividend Cafe, where we are continuing to live in the exact same environment that we found ourselves last week that I talked about in the Friday Dividend Cafe. Let me start with that. The Friday Dividend Cafe did a deeper dive into other investment considerations of this current military operation in Iran. The major takeaway, I really would prefer you go to the Friday Dividend Cafe to get more meat on the bone, but essentially suggesting that this idea of high, elevated, exacerbated intraday volatility is the most likely scenario for the time being. I don't see it going away anytime soon, and I don't care about it at all. And it cuts both ways, and it's going on every day. And it reflects all kinds of horrifically bad trading habits. So what happened is the futures last night were down about 1,000 points. At around 4 a.m. this morning Eastern, they were down 700. They got as low as only down 400. The market opened down 500. We went down nearly 1,000 points, and then we closed up over 200 points. You had this, 1,200 point intraday gap between the bottom and the top being very near the closing price of the day. So that same trend played out, although it could have been in the opposite direction with the peak coming earlier in the day and the trough coming later in the day. But most often it was this back and forth teeter-totter. And it really more or less happened every day last week. There was one day that was a little less volatile than others. The other piece to it today, though, was in the oil prices itself, where, I mentioned on Friday that WTI last week, the day after the weekend's war activities on the Monday was only up 5.5%, which was child's play in the grand scheme of things. And then by Thursday night, when I was speaking to a dinner of clients in Nashville, I said, we were up 17%. That's starting to get a little more real. And then by being up 9.5% on Friday, it meant we were up 31% on the week. And I'll let you guys figure out the math as how 17 and 9 gets to 31, because I don't have time to do it right now, but I'm not wrong. But so then you end the week up 31% in oil, and that's a major issue and has economic repercussions and certainly market ramifications. Then all of a sudden, it skyrockets higher as the oil futures opened last night, and that was putting downward pressure on the equity market futures. We actually hit $115 a barrel today at one point. And then as I'm sitting here now, we're at $83 or $84. What caused equity markets to reverse to the upside? What caused oil prices to reverse to the downside? Because it is one and the same in terms of that inverse correlation right now. The president apparently made comments to a CBS reporter that he thought the war was almost over. And whether or not that's true, what he meant by it, what the whole repercussions around it, the markets, traders are so afraid of getting caught off sides of this stuff that there is just massive, violent reactions both directions. And this is the dumbest thing I see. Overreaction in each direction, people trying to game this stuff, not wanting to be caught off sides. There's hedging activity, there's unhedging, there's most certainly speculative activity, and no sane investor has any place getting in front of this stuff whatsoever. Obviously, $83 oil is a lot better for the U.S. economy and therefore market prices than $115 oil. But the 115 itself didn't seem to make a ton of sense, and it did not last long. And when I say it didn't last long, it's possible it lasted for something in the range of 3 seconds. So what else do we want to comment on today besides this heightened volatility being the major theme? And for all I know, we open up 500 points tomorrow. We open down 1,000 points. We do both in the same day again, which has been the bigger trend. I have no idea, and neither do you, nor should you care. On the market side then, 10-year bond yield, actually treasuries were up a little bit today. The 10-year was down 2.5 basis points, 4.1%. Top performing sector today was technology, up 1.8. financials are one of the only sectors that still closed in the red. It was down about 0.5%. But, I want to point out that last week, with the overall downside market volatility, the S&P was down 2%, the Dow was down 3% on the week. That isn't very much. And 38%, I want to get this right. Yeah, 38% of stocks were at 20-day lows. So two things can be said about that. That isn't a lot for a major market sell-off. And you could say, well, that's the half full part. Okay, the glass is half full. But then the glass is half empty as well. There's a lot more worse it could get, a lot worse it could get from here. So both things are true when people are looking at these stupid short-term indicators. But I would point out that the breadth in Thursday's sell-off was 3 decliners for every 1 advancer. And 3.5 decliners for every 1 advancer on Friday. 3.5 to 1 downside breadth. That is really not that bad at all. You have real significant down days sometimes with 8 to 1, 9 to 1, 10 to 1 decliners to advancers. So the breadth was very limited. All of this can get worse, but none of it has really been all that bad. All of it is acting just like you would expect in terms of short-term paranoia, fear, uncertainty, all that type of stuff that exacerbates volatility. What else do we want to highlight? Oh, I also talked, by the way, Friday about the backwardation of oil futures, that on one hand, we had spiked up to that $90 level. Today, it obviously went way higher than that, now back lower, but still into the 80s. But that's the front month curve, the front month contract for oil futures is at that level. And then when you go out 9 months, it's coming all the way down into the 60s. So you're paying a lot more for oil for 30 days than you are if you want to secure a price for 9 months from now or 12 months from now. The VIX, which is the S&P 500 protection, it basically captures implied volatility, but the cost of buying puts on the S&P is also highly backwardated, where the protection for the next week and the next month is far higher than it is for 2 months, 3 months, 6 months, etc. So this all reflects short-term jitters, but again, at this time, almost no serious market actor, and I would add very, very few serious political prognosticators expecting this to draw out. So last week and into the beginning of today, that again obviously got interrupted at the end of the market day, the downside concerns are all correlated. Every market analyst that I respect, who I talked to over the weekend and interacted with and corresponded with, and there were quite a few, all believe that it just is simply markets trying to assess exactly how long this may end up going on. And that it may not, the realization that it wasn't going to be done in 4 days. But people trying to now price in that it might be 4 months, I think would be making a much bigger mistake. So that timing issue continues to be very important. Obviously, a lot of the questions about the Strait of Hormuz, it's tricky to figure out about the shipping lanes reopening. On one hand, it does appear to me that the Iranian Navy really doesn't exist anymore. And they can certainly send more U.S. support to secure the straits and the ports for some safe operation. But if insurance companies do not want to protect the ships, and there is that heightened volatility around what to expect, I don't know that it gets immediately better. And this is not just an oil story, but a shipping of cargo goods as well. So we're watching the news on this front as well. But again, I think that it's more likely than not to stabilize. One of the questions was like, are they going to take out Kharg Island, where 90% of Iranian oil exports go from? And increasingly, what I'm reading is that it's unlikely that the U.S. wants to fully take out Iranian oil infrastructure, because they still hope that they end up with a friendly regime when all said and done, and want to have Iranian oil capacity available in the hands of a better actor and not radical actor. And so that they would set their own cause back if they were to more severely take out the oil infrastructure side. I've also read that that's a source of debate, dispute, disagreement between Bibi and President Trump as far as U.S. and Israeli attention to that issue. But I don't know that that's true. But again, we'll continue to see where that goes. One of the benefits to oil not getting back up above 100 is it eliminates some of the temptation for policymakers to do some really dumb things, to go release oil from the Strategic Petroleum Reserve, to talk about maybe banning oil exports, to do any kind of price controls on oil itself. It's completely unnecessary. And in the 80s and even I would argue 90s, it's less tempting to go down a desperation path of bad policy with unintended consequences, with inviting of distortions. But when you start talking about $115 oil, policymakers can do some pretty crazy things. All right, I don't want to talk only about Iran and oil. The jobs report Friday could have been a number all of its own. A lot of the market downside on Friday was not just Iran, but was related to the horrific jobs report that came out Friday. Unemployment ticked up to 4.4%. I understand people are saying that we had a loss of 92,000 jobs when we were expecting 55,000 gain. That's true. But there was also another 69,000 of downward revisions from the prior 2 months. So you really had a net decline of 161,000, which is a 220,000 delta from what had been expected. And to this idea of, well, okay, but we're just getting rid of these government jobs. No, the vast majority, 86,000 of 92,000 job losses in February were private sector. 12,000 were manufacturing jobs, which I think is 12 months in a row of downward negative numbers in manufacturing jobs. Then some will say, well, the civilian employment measurement has been different. And there have been months where one was bad and the other was good, or one was good, the other was bad. But the civilian employment measurement, which basically factors in small business formation, was down 185,000. So you really had just bad numbers all around. The only thing I could say, if I'm trying really hard to look at a glass being a quarter full, is there was a nurses' strike that has ended that may have padded the downside numbers a bit, and that should reverse into next month. And then we know that there were definitely weather issues that would have affected retail and things like that. But the seasonal adjustments might have captured that. So we'll see what lies ahead. I'm going to have to leave it there. I've gone on quite a bit on a lot of the Iran stuff. The oil prices will be the big factor this week. We'll continue watching all that. So let me leave it there. As I'm talking, down 8% in oil at $83.50. So you're just seeing massive double-digit percentage moves up and down. By the way, midstream energy was up 2% last week when the S&P was down 2%. But the real winners were downstream. The refineries were the big energy winners. Within midstream, LNG export, U.S. in a very profitable, competitive, opportunistic position when LNG export capacity in the Middle East is offline. Ask TBG is posted on the homepage at dividendcafe.com. The CPI number for February comes out Wednesday. But does that really matter now when the numbers have all changed so much in commodity prices, oil, gas, aluminum, just in the last 4 or 5 days here in March? The February number really is obsolete before we've even gotten it. Okay, I am recording here in Miami. I've been in meetings all day long at a big conference here and speak at the conference tomorrow. Then I'm back in New York City, and we're going to keep plugging away. Reach out with any questions you have. Just trust me that if you're a client of our firm, your advisor, would love to hear from you, talk you through any questions you have about what's going on. Myself and Brian, our investment committee, I am very happy to engage on anything you have that you want to know as we go through this period. But I will tell you that the market and investment advice I have right now is to not just do something, but stand there. Have a wonderful Monday evening. Thanks for listening. Thanks for watching. And thank you for reading the Dividend Cafe.